studying your last two. I swim med when they turned in. The staring down to mute. And can lend a pole that sunk he died.
A shareholder loan is one of the most common accounts you will see in the books of a privately owned corporation. Despite its name, it is not always a traditional loan like one you receive from a bank. Instead, the shareholder loan account is simply an accounting record that tracks money moving between the corporation and its shareholder. Think of it as a running balance that answers one simple question: who owes whom? Money can flow in both directions. Sometimes the corporation provides money or pays expenses on behalf of the shareholder. For example, it may give a cash advance, pay a personal expense, or allow the shareholder to use corporate funds. These transactions are recorded in the shareholder loan account because the shareholder may now owe money back to the corporation. At other times, the shareholder provides money to the corporation. The owner may inject additional cash, pay business bills using personal funds, or temporarily finance the business during a cash flow shortage. In these situations, the corporation may owe money back to the shareholder. The shareholder loan account keeps track of all of these transactions in one place, making it easy to determine the outstanding balance between the corporation and its shareholder at any point in time. The important thing to remember is that a shareholder loan account is simply a record of amounts owed between the corporation and its shareholder. It does not automatically mean that money was borrowed from a financial institution. As we move to the next sections, you'll see why maintaining an accurate shareholder loan account is essential, because these balances can have significant tax consequences if they are not handled correctly. Now let's see how the shareholder loan account actually works in practice. The easiest way to understand it is to think of the account as a scoreboard that keeps track of who owes money to whom. When the corporation pays money for the shareholder's personal benefit, the shareholder now owes money back to the corporation. For example, the corporation may provide a cash withdrawal, pay the shareholder's personal expenses, make a mortgage payment, or even pay for a personal vehicle. Each of these transactions increases the amount the shareholder owes and is recorded in the shareholder loan account. On the other hand, there are times when the shareholder provides money to the corporation. The shareholder may deposit personal cash into the business, pay business expenses using personal funds, lend money to help with temporary cash flow problems, or contribute additional capital. In these situations, the corporation owes money to the shareholder, and the shareholder loan account reflects that balance. The important point is that every movement of money between the shareholder and the corporation affects this account. That's why accountants carefully record every transaction throughout the year. Even small personal payments made from the corporate bank account can change the shareholder loan balance. A simple way to remember this is, if the corporation pays personal expenses for the shareholder owes the corporation. If the shareholder puts personal money into the corporation owes the shareholder. Ultimately, the shareholder loan account is nothing more than a running record of who owes whom. Keeping this account accurate is essential because the balance at year-end can have significant tax consequences, which we'll explore in the next sections. In day-to-day bookkeeping, shareholder loan transactions occur far more often than most business owners realize. Almost every time money moves between the shareholder and the corporation outside of salary or dividends, the shareholder loan account is affected. For example, if the corporation pays the shareholder's personal credit card bill, personal mortgage, or even personal groceries using the corporate bank account, those payments are recorded in the shareholder loan account because the corporation has effectively advanced money to the shareholder. The opposite is also common. A shareholder may deposit personal funds into the corporation when the business needs extra cash. purchase office equipment using personal money, or temporarily lend money to help the business through a cash flow shortage. These transactions are also recorded in the shareholder loan account because the corporation now owes money back to the shareholder. This is exactly why shareholder loan accounts are so common in owner-managed businesses. They provide a simple way to track temporary advances, reimbursements, owner funding, and many other transactions that occur between the shareholder and the corporation. Modern accounting software automatically records these entries as they happen, but the accountant must still ensure that every transaction is classified correctly. Whenever you review a transaction, always ask yourself one simple question: is this a business expense or a personal expense? Answering that question correctly determines whether the transaction belongs in the corporation's books, the shareholder loan account, or somewhere else entirely. The key takeaway is that the shareholder loan account is a living record of everyday financial interactions between the shareholder and the corporation. Maintaining accurate records throughout the year is essential because these balances can ultimately determine whether additional taxes apply under the shareholder loan rules.